everyone, I have with me Mr. Kalpen Parekh, who is the MD and CEO of DSP Mutual Fund. I'm here to talk to him about emerging trends and a few questions on the mutual fund industry. Thank you so much, Mr. Kalpen, on taking out the time to talk to us. When we are talking about sectoral growth, and where do you see the next opportunity coming from, especially with interest rates, keeping the whole interest rates in mind or inflation in mind? Where do you see the next sort of growth coming in the segments and also consumption growth for that matter? So where do you see the opportunities right now?
So as you see in the recent times, both on inflation and interest rates, India and policy making in India has been reasonably stable. So, our inflation is much lesser than the rest of the world. And while in the last 18 months, central banks have raised interest rates, but the hike or spike in interest rates in India also has been reasonably calibrated. In last rounds, over the last decade, whenever rate cycles have reversed, the 10-year yields have gone to as high as 9%, but this time around they peaked at 7.5%, and now they've come down to somewhere around 7%. So I do see a fairly stable environment, both in terms of the inflation and interest rate setup. The largest weight in our portfolios are top banks and select top NBFCs. The thesis behind this is that the balance sheets of banks in the last 4-5 years have massively cleaned up. And anyways, the top 8 banks were always a push. Credit growth was muted in the last 5-7 years because the economy was slow. But that trend has also changed in the last 18 months, and we expect reasonably strong double-digit credit growth. And net interest margins of these banks also are at reasonably, they are at all-time high. So the health of the banking sector looks very good. Another sector where we increased our rates in the last 6 months or so is healthcare. The healthcare sector almost peaked in 2015 in terms of the earnings growth and valuation. And since then, it was in decline over the next 4 years. It got a short boost in between because of COVID and some spike because of some medicine launches and stuff like that. But again, after COVID, the sector more or less underperformed the rest of the other sectors. So we find that sector also now in reasonable valuation zones. But to give an example, in our last year fund, the benchmark rate of healthcare is 3%, but our portfolio is around 15% rate. In our value fund, we are around 8 to 9% overweight. In many of our funds, the healthcare rates are much higher than what the benchmark rates are. So that's the second sector where we are overweight. The third sector, I think, is auto. Auto, again, since the last year or so, we have gradually increased our rates. On account of two things, most auto companies were again at a 5-year or a 10-year low in terms of volume growth. And coming out of post-COVID era where metal prices had risen and semiconductor chips availability was not there, so volumes and margins both had got impacted, and both of them were about to turn, or they were at their all-time worst.
Right, and talking about sectors, Nifty IT something, an index that the fund that you had come up with recently. Now, this is after we saw slowdown in the IT sector and also expectations, at least, with many brokerages have been downgrading the stocks and also saying that at least by 24-25 still look some sort of, sluggish in nature. So keeping that in mind, what is your rationale behind, launching the fund, and how do you see the whole sector, the IT and the tech sector, going forward?
Actually, we like that to launch funds because when the news flow is bad, when the cycle is weak or slow, when managements themselves are, feeling less confident about their own prospects, that's one side of the coin. But because of all of these, the other side of the coin is even prices have corrected. In the last 18 months, the whole sector has corrected by 20 to 40%. When we have this ideology at DSP that whenever we're launching funds, we attempt to try and time it reasonably well when either the valuations are low or the business cycle is at a low. But in case of the tech sector, valuations have derated, but maybe there is still some more room for that to happen. But the business cycle also has turned slow and weak. And we always like to launch funds in a low because investors get advantage of low prices. Ultimately, the simple rule of investing is you buy low and sell very high. So the only way we can help investors acquire more units is when the NAVs are cheaper. And in the tech space, we are already seeing, we're launching it after a reasonable few quarters of price correction and earnings slowdown. So it gives us more confidence that from a margin of safety point of view, from a valuation point of view, the fraud is over. And if you build a portfolio over the next 6 months to 12 months, it is a very good time to acquire these companies. So this is more from a timing of valuation of the business cycle. But that apart, if you see the fundamental operating metrics of the sector are generally, more superior than most other sectors.
There's one more, a concept that many investors have been chasing is the whole story of small caps and mid caps. And small caps, firstly, I think they are, of course, said to be very risky and volatile in nature, but also said to be the next potential multi-baggers. So, what do you have to say on the whole chase of the whole small cap scale?
See, no doubt in the last 2-3 years since COVID, two things have happened. Investing has become simple because of technology and access and great UI UX. When you press few buttons, then you can buy stocks. So many investors have become many consumers have become investors, where people opened broking account and started investing. And the first choice was small caps. Of course, in the same period, small caps also went up very sharply in the last 2 years or so. Since COVID lows, they have gone up the most. So there is always this comfort that the last 2 years returns are good, so let me add more. But we always tell investors that the last 3 returns are not your returns. They are only to those who invested 3 years back. Today, you're going to invest. You're buying at today's prices, which are higher than what they were 2 years back. Now, as you rightly said, small caps are volatile. Small caps also make money, but not all small caps make money. So here it's important to know that more than 80-90% of small cap companies from the whole universe generally remain small. They don't naturally become big. So it is not right to paint with one brush that all small caps make money or all small caps are indicators. A very small universe of the small caps actually become big. In fact, I would only take this opportunity to tell viewers that don't chase market caps. Chase the profiles of companies which have drivers to make superior long-term value creation.